I want to switch gears now and talk about the Fed because investors know that Federal Reserve officials have started discussing plans to taper those monthly bond purchases, and minutes from their July meeting have just been released. And we've got our Fed correspondent, Brian Cheung, here now. I know you were just able to peruse those minutes, Brian, and I'm wondering if they show just how splintered the debate over tapering stands.
Well, splintered indeed it is. I have to say that when it comes to looking at these Fed minutes, this is one of the more complicated ones that I've had to read just because of the divergence of views across the committee about what to do with regards to its $120 billion a month pace of asset purchases. But when you pare back the details of these minutes, which again cover that July 28th meeting. So again, this was before we got that pretty hot print on July jobs, which came after this meeting. But it did note that there was some varying views about whether or not members of that 18-member committee were ready to advance talks on tapering. So what the minutes say is that apparently several participants, or rather some participants is the way that the minutes described it, said that it would be prudent to prepare to start reducing the pace of quantitative easing. Again, not necessarily detailing the timing of that. And then few participants on the committee expressed concern about a buildup in financial risk that could be happening as a result of the Fed's purchases. So again, kind of in the similar vein, but for different reasons, also maybe expressing an eagerness to begin the tapering process. Whereas on the other side of the coin, you had a few members of the committee, as noted in the minutes, that said they wanted to be cautious of the downside risk of the delta, but didn't necessarily say that those people, even though they're a bit more cautious, weren't necessarily in support of paring back those purchases at some point in time. So in totality, you can kind of read these minutes as saying, yes, the taper will happen at some point. It's just when that taper does happen, there's going to be some questions about how the Fed should be balancing the risks as they do slow the tapering process, which could set up a very interesting debate with the mechanics for how they'll do it. In what magnitude at some point later this year when they do start the tapering process, should they be winding down their agency mortgage-backed securities or their U.S. Treasuries purchases? And what's also interesting is that they also detailed the communications challenges that are associated with this type of process as well. I want to read you this bit, quote, "Nonetheless, a couple of participants cautioned that it could be challenging for the public to disentangle deliberations about the two tools, those two tools being the quantitative easing program, those asset purchases, and then near zero interest rates," and then also added that, quote, "any decisions the committee made on its asset purchases would likely influence the public's understanding of the committee's other policy intentions." So this isn't necessarily members of the Fed saying that we're questioning our ability to execute this tightening process without some sort of credibility challenge to the Fed's framework, but just merely saying that Fed officials and Jerome Powell himself in the press conference should be very careful about the way that they message how these two tools work in tandem. One being, if you do start to slow the pace of asset purchases, that's not necessarily tightening policy, but just merely trying to slow the accommodation that it's providing, because it'll still ultimately be buying assets after the taper talk, just at a slower rate, which they want to decouple from the whole separate tool of eventually raising interest rates, which we know the dot plot projections in the June meeting told us could be happening at a clip of maybe 2 interest rates before the end of 2023. So very interesting remarks here. There were also some remarks about the diverging views on inflation. There were some that noted that survey-based measures of inflation were more concerning, whereas you had, quote, a couple of participants noting that readings on forward inflation compensation could actually be read as suggesting investor concern that inflation could run below the Fed's 2% inflation target. So actually, there are some members of the Fed committee that see the downside risk of inflation actually still being below the Fed's target. But all in all, it seems like it should be setting up a very interesting Jackson Hole commentary for next week, Alexis.
Oh, you bet. I think you're going to be very busy covering that conference. Brian, before we let you go, any mention there or a feel for if the majority of Fed officials are backing those 2 interest rate hikes by the end of 2023?
No, not necessarily. And for what it's worth, the Federal Reserve in these types of meetings, they don't necessarily talk about those types of forecasts in a way that the minutes would capture anyway. Even in the event that it was a meeting where they are submitting those dot plot projections, which again are those kind of it's a map, if you will, of where policymakers could see interest rates going. That's almost a worksheet that they fill out at the meeting, not necessarily a point of conversation. Even if that were the case, that wasn't part of the discussion in July because July didn't have a fresh round of those those dot plots. We will get another round of those dot plots in the Fed's next meeting in September. So rate hikes not, again, part of this discussion, but underscores what I just highlighted in those minutes. There are members of this Fed committee that are very concerned about people confusing the two tools of quantitative easing and possible tapering and interest rate hikes at some point.
All right. Thanks so much for breaking it all down for us, Brian Cheung.